Our first presenter is going to be Ron Haydt. He's the CEO of MarketTamer.com. Ron has taught thousands of traders from all over the world. He's passionate about helping other retail traders protect and grow their stock market portfolio through the application of options instruments. Option trading can often sound very complicated, and Ron loves to keep it simple. Use proper risk management and improve the trader's overall results. Today, he's going to be showing us how to fix your broken trades. Ron, are you there?
All right. Hey, thanks so much, Kevin, and thanks to Mark and inviting me here today. Hey, gang, I already see some friendly faces, so this is awesome, and I see a lot of new faces too. My name is Ron Haydt. I am the CEO of Market Tamer. I am a trader. So as we go through today's presentation, not only are you going to, see what we have, see how we do it, but you'll be learning from somebody who does trade. Before I go any further, though, for the government, I do have to say the disclaimer on your screen that nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. And now we know the NSA has a copy of it too. So again, hope you're doing great. It's awesome to be here. You already have received some emails about the topic of today's event. And it's going to be talking about fixing broken trades. But it's not just going to be about fixing broken trades. It's also going to be about income, where when we have an underlying security, that stock, whatever it might be, whether it's an ETF or an individual one, we can be protected during downtrends, make money in uptrends, and also make money at other different times. And what I want to do is, this presentation has been altered a little bit at the end because I want to show you guys a very simple and basic way to trade around a stock position using option instruments. And it's going to be a very powerful strategy that you guys can take with you compared to your own stocks. Is every strategy perfect? No, none ever will be. But you know what? For many stocks, it works. And sometimes we can even adjust some things and make it work on that particular stock. We like stocks that trend. We like stocks that have symmetry. Because people that trade stocks over and over again, well, they leave footprints. And it's amazing how you can trade the stock over and over again the same way. It's almost like being comfortable with a friend. You know what your friend's going to do if you do that or you do this. You know what the outcome's going to be. And that's really important. So we have watch lists. And I encourage you guys to, get that watch list and trade that stock over and over again. Because you know what? You're going to learn how that stock trades. And it's going to give you that little bit of an edge. So without further ado, I do want to get started. Oh, and one more thing. What I've also added based upon requests is, even though I want to keep it simple to affect the most people, I've added a spread trade at the end. The second example, we're going to talk about how to fix that as well when it goes against us. And it's a pretty powerful way to trade because sure, we can take losses. But what if we could fix 8 out of 10 or 9 out of 10 of those? It would make a huge difference in our portfolio. So let's go ahead and jump in. I have about 45, 50 minutes here, so we're going to be going pretty fast. And then I'm going to do a Q&A at the very end. So let's just jump right in. This is this is one of my favorite presentations because the pictures are pretty darn cool. So we're going to be talking about fixing broken trades, right? So to talk about today's topic, we know accidents happen, right? Car accidents, sporting accidents. The gentleman, I love this slide. So every time I do this presentation, this one just is very, very, very painful. And recently got married, so my wife makes sure I have a cat picture in every single presentation I do. So there it is, and it's on record. And of course, us as traders, we know that stock market accidents happen. And the question is, how are we going to protect ourselves? Because no matter how often you traded, if you do everything right, everything you're supposed to do, you follow the technical analysis, you followed what the book said or what the presenter said or, your trading buddy, sometimes there's going to be a mistake. And one of the stocks that we like to go back and reference to is Facebook. And you might do everything right and still it may go wrong. And the interesting thing about Facebook was Apple is always the #1 talked about stock, always. And then came Facebook. And finally, it overtook Apple as the number one stock to be traded. And we kept telling to our members, listen, we're going to track Facebook because it was just so ungodly popular. But we're not going to do it until first options come out. Because if options aren't traded against the stock, we can't hedge our risk appropriately. And that's how we like to do it. It could be the best stock out there, but if there's no options, we're not going to trade it. So when Facebook came public, man, it was like a fireworks show. You thought it was the 4th of July. Everybody's asking, okay, we're going to go. I'm like, no, hold your horses. They don't take companies public to make you is me and you, the retail trader. They don't do it to make us rich. They do it to make themselves rich. So when the smart guys are selling, we don't want to be buying. We've seen this before. And the interesting thing is, it happened in 2007, with Blackstone when they took it public. And did Blackstone recover? Well, sure it did. But here's what happened to Blackstone when it did go public. It dropped by over 50%. It actually got absolutely cratered. So when Facebook came public, we said, folks, listen, on the rare occasion, they go public and they do go vertical. But let's just wait. There's going to be some selling. We're going to pick it up lower. So when the price got down to 40, we said, don't touch it. 35, don't touch it. By the time it got to 30, we basically just said uncle. I mean, it was just that much. People kept saying, come on, let's go buy this. So we put a position on for tracking. And we were 100% wrong. Why? Because Facebook dropped another third. It was down by over half from its IPO day. Now the joke is, Facebook should have been renamed FP for Faceplant, because that's how investors felt. And it was one of those things where we said, told you so. Sure, it may go to 50, 60, 100 a share, but it's not going there in a straight line. And the institutions are going to dump their shares. They're going to make their money, and we're going to go pick it up later. But here's the thing. Even though we started that position around 30, we were 100% wrong. But we were still basically 99.9% sure we could turn that loser into a winner. Why? Because we've done it before. We use a really simple system. It's not proprietary. I'm going to share it with you today. But when you understand that stocks do repeat movements, and if you find stocks that have symmetry, stocks that have trends, this is actually a pretty powerful way to keep you on, quote, the right side of the trade, to know if the bulls or the bears are in control. So I'm going to share with you how you can recover from a really bad trade and potentially turn it back into a winner. Because you should know how to do this, because you do it everywhere else in life. If you have an accident, you cut your finger, you hurt yourself, you're going to a doctor, right? Your pet has an accident, you're going to the vet. But what happens if your portfolio, your nest egg has an accident? How are you going to fix that? Well, just like a mechanic fixing a car or a pilot flying an airplane, you need to have a plan to fix the portfolio when things go wrong. Because someday, the trade is going to go wrong. It's impossible for it not to. Think about it. Would you really let a pilot go fly an airplane without knowing what to do if things went wrong? You wouldn't go to a doctor who had no idea how to make you better, right? So why on earth, something you've worked your entire life for, especially those of us that are closer to retirement, why would you ever risk your nest egg without having a plan? And the reason you can be sure things are going to go wrong, nobody has a crystal ball. And even though you're going to research a company using technical analysis, fundamental analysis, maybe even sentiment, macroeconomic, your expectations can be wrong. And once you can admit to yourself that, you know what, one day I am going to be wrong, you can embrace the idea that fixing what's broke. And to do so, we got to have a trading plan, because you know what, you're going to have these two little gremlins on your shoulder. One's on greed, one's on fear. One's saying buy, 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 one's saying sell, sell, sell. We got to put those in check, because without it, we're going to take losses quite regularly. And we just had tax time, right? And we've all had losses. But what if we could turn those losers into winners? Think about all the money you lost over the years. We've all lost money. I've lost money. But what if we could take some of those losers, a couple $1,000 losers, turn them into winners? On a 10K portfolio, we're up 10 versus down 10. If we could just not lose, it would be amazing. And then what if we could turn some of those into winners? That's a huge, huge deal. Think about how much extra money you'd have just by not losing. Hey, stop losses work. If you're just trading stock and that's all you want to do, fine. But if we have the ability to trade options, we can go from a bull 1 minute to a bear the next. And when I show you the stock example that's going to be coming up shortly, we're going to talk about how we're going to flip from being bullish to bearish. And it's really going to be highlighted when I talk about how to adjust a spread trade. So it's better to lose. Well, we know that. That's a no-brainer. But if we want to fix broken trades, what do we need? We need patience to act at the right time and discipline. When that time arrives, we now act. And this is all formulated with a plan. So no matter who the successful athlete is, whether it's the new NBA draft picks or the folks on your screen, they don't get successful by training for a weekend. You don't get rich by just doing it overnight. And while it is possible to get maybe lucky over the weekend or rich overnight, usually you take a whole lot of risk and it's not repeatable. And that's just not a good way of doing it. What we want to do is we want to put the right plan in place at each turn. We want to do the right thing at the right time. We want to pick up all the nickels as we go. So we have the saying that the jug fills drop by drop. We're not worried about making every dollar that the stock moves. But when the stock does change direction, we want to be protected. We want to act accordingly. We want to think of the nest egg as the same way. So you want to grow your nest egg each month, each year, and you know what? By the end of the year, it's going to be a winning year. Making 3% a month or 4% a month or 10% a month may not sound like much. But you know what? You add that up each and every month, all of a sudden you're beating every hedge fund on the planet. In the following example, which I'm sure you're ready to see, I'm going to show you a step-by-step process that a position that goes completely wrong. I'm going to show you how to turn a stock trade, something that you bought, that you want to hold on to for a long period of time, and turn it into a winner. And we're going to use a very clear plan. It's going to be easy to follow. It'll be repeatable. You can take it to your own stocks. It'll be step by step. So I'm going to show you how to fix a broken trade. We call it the market tamer way. I've purposely removed the stock symbol, but before I go any further, I want to say this. This is a very basic example. I know I'm really good with names, and I can see you guys have seen me before, and I see a lot of new folks. I want to make it very clear, though. The example I'm about to show you, very simple, very, very basic. Those of you that are a little more experienced, or very experienced, you might be thinking, now wait a minute. We could do this. We could do that. Holy cow, Ron didn't even talk about that yet. There's a lot of really cool things that I'm going to show you that after we get done and I tell you, hey, we're going to turn this loser into a winner and make this much money, X%. And you're going to say, but what about this, this, this? It could totally blow away that return. This is going to be the bare bones effect, not the prettiest, the prettiest example ever. So it's very important, very, very, very basic. So here's the deal. Imagine we're all going to purchase the stock at $72. Now I want to highlight two things on your chart. The blue line is a 5-day EMA. The red line, 20-day EMA. Okay? That white circle is where we're buying the stock. And if you look to the right of that very right of that circle, you're going to see the little white candle, right? That's where we're going to buy the stock. We wanted to track it for our members to show them, hey, it looks like the stock's in an uptrend, right? Over the course of the past month, each candle represents a single day. It's been moving a little higher. It looks like it's getting its mojo back. Moving averages are pointing higher. Hey, whatever. We think it's a good time to buy. And this was the hilarious part. This was the ironic part. After we bought the stock, that's what was funny about this. It's the white candle. It just goes down. Like, really? Are you serious? We buy it and we literally drop 4 straight days. So here's what's going to happen. The blue line, which is the 5-day, is going to cross down through the 20-day. In very simplistic terms, okay, and we're keeping this simple, that is a sell signal. This is for longer term trading, and I want to point that out too. Let me pause here for a second. Those of you guys that day trade, this has no bearing on that. Those of you that want to buy a stock today and sell it 5 days from now, this has no bearing on that. Most of the folks here, and one of the most common requests that I get when I travel and I speak publicly, whether it's at meetup groups or at different bigger events, is most folks that are closer to retirement have long-term stock positions. They don't necessarily want to get in and get out today. That's not the plan. They may have those trades in another portfolio. They may have those trades in the same portfolio, but they have these great companies. Maybe they pay a dividend. Maybe they just have great growth ahead of them. I mean, Apple never paid a dividend until recently. It had fantastic growth over the last 10 years. So whatever it might be, these are long-term positions, very important to note. And the point is, when stocks go down, you don't have to be a deer in the headlights. You can retain that stock. Because even stocks like Berkshire Hathaway, Apple, whatever company it might be that has good fundamentals, that makes a real tangible product, that has a future. As the institutions buy and sell, these stocks go up and down. And a lot of times you'll see somebody that says, yeah, the stock was up at 80, down to 40, and up at 80. I'm break even. Well, I'm about to show you that it's all going to change. We don't have to be a deer in the headlights when the stock goes down. We can cheer for it. So here's what we're going to do. Keep in mind, long-term stock position. Blue line crosses down through the red, okay? We are now going to buy a long put option. A long put is an insurance policy. It's going to protect us. We're going to buy it at strike 70, and again, just for ballpark, we're going to go out 3 months. So if we buy the stock at 72, we then add a long put at strike 70, we now have what's called a married put. It is protection. It is protected. We have unlimited upside reward. But now, if the stock were to decline precipitously, or even dramatically and going to zero, we're protected. We can always sell the stock at the long put price of 70. So what's the risk? Well, we paid 72 for the stock. We paid $7 for the put. That means our cost basis, 77, double sevens. What's the risk? Well, I already said that we could sell the stock at 70 if the stock went to zero. So our risk is the difference between the cost basis and the strike price, which is $7. That's it. Our risk is 7, and now if this little sucker starts going down heavily, we are not going to lose our shirt. Now, red arrow is where we bought the stock. You can see it's trended down to the lower right of your screen. It's now around $58 a share. So I have a question, and if you want to play along, that'd be great. It's always fun. Would you sell the long put now? Go ahead. Just commit. You can type Y, you can type no, you can type yes. Go ahead and have fun. I'll wait here just a couple seconds. Let everybody sort of have some fun, can maybe commit to an answer. I'm assuming I can see the questions here. All right. They're coming in. Okay. It's weird though. I can sort of see your questions, but I sort of can't. I don't think it's working on my end very well. Some more coming in. Wonderful. All right, so here's the deal. I asked you to commit to one just for fun. Even if you didn't answer me publicly, here you go. Whatever answer you gave is the right answer. Why? It's your answer. Many of us who traded long put options know that yes, as the stock drops, that long put's going to increase in value. It's going to make us some potentially serious money. But we also know as long put traders, it doesn't take much for that stock to bounce, and then all of our put profits are gone. And then we usually say a couple 4-letter words. However, is the stock done going down? Interesting. If you decided to bank profits from the long put position, you just found out that you are more aggressive by nature. If you decided to hold those long puts, you just discovered you are more conservative by nature. Remember, whatever answer you gave me was the right answer. It was your answer. What I also want you to keep in mind, though, this was a long-term stock position. This was not a quick buy and sell thing. And I want to point out that the blue line never did cross above the red line. Therefore, no bullish crossover occurred. And what do you know? The conservative traders, they were vindicated in holding their long put positions, given that the stock dropped over $10 since the last point shown on the previous chart. Wow. The trend was bearish. Again, the people that sold early, maybe they have higher risk tolerances. That's why the answer could be right for them. But if you're playing this close to the vest, if you're taking this as, hey, listen, I don't want to risk my nest egg. I got to protect this. This is so I hopefully don't have to go get a job when I retire. There you go. With earnings imminent and the stock now at $50, remember we bought that sucker up at 72. We do not want to hold strike 70 long puts, because if the stock pops up, as option traders, we know it's going to wipe out much of the profits. However, we also know that earnings, unless you have an inside line to the financials, you don't know which way that stock's going to go. It's a 50-50 bet. So we need to have some long puts for that earnings report, because what if the company has a really bad report? It could drop further, right? So what we're going to do here is we're going to do something called rolling. We're going to sell to close strike 70 and bank some serious profits on that long put option. We're simultaneously going to buy to open a new set of long puts, but this time at a lower strike price, right at the money, right where the stock is trading, $50. And again, it's just called rolling. Now here's what happened. We paid $5 for those long puts at the bottom of your screen. We sold them for $20. So if we assume there's no extrinsic value, again, we're using worst case numbers. We're not using the prettiest numbers. We made $15 on that long put. I understand the stock dropped $20, but we made 15 on a good company, good fundamentals that just happened to go through a downtrend. Our cost basis has now been reduced. The new cost basis, $72 is what we paid for the stock, minus $15 because we made profit on our put, and we also paid $3 for the new put. So now we're looking at $60 cost basis. I do understand that it's still higher than where the stock is trading, but that's okay. Well, now we've arrived at earnings, and the stock did gap higher. Not only did the stock gap higher at earnings, it stayed up. Hey, for whatever reason, why the stock trended down, stocks trend seasonally, maybe it got a downgrade, maybe the downgrade was bogus, maybe the market went under a normal correction. The stock bounced up. Turns out earnings came and they delivered. So with the stock popping up, we didn't lose all our profits with the long put because we cashed it in. We bought a newer lower strike long put. Now with the stock at 60, the long puts are basically worthless. And that's okay, because we only lost $3. Look what happened to the stock. Now, it rips higher, it does pull back, and then it goes right back up to the price we bought it. Remember, all the way on the left, that white candle, that signified the entry, literally the top at that time. Pretty amazing. So I have a question. What are all those folks saying on the left when they bought at 72, like we did, and now the stock's back at 72? What do you think those people are saying or doing? Are they saying, holy macaroni, we got our money back? Were they even in the trade that long to get the money back? A lot of good questions, right? Well, let's do a comparison. If you did the buy and hold strategy where you didn't do anything, you just bought the stock, you put it in the IRA, the 401k, or the cash account, and you just said, listen, I'm going to go buy Apple, or I'm going to go buy Berkshire, or whoever it is, and I'm just going to throw it in the account and not worry about it. Really? You know you're going to be checking on it. You were break even after many months. And most importantly, you suffered a heck of a lot of stress during the downtrend because you had no idea how low the stock could go. If I back up a slide, how many folks would have ridden this stock down? And be honest, even if you don't answer, just be honest with yourself. How many folks would have rode that stock down to the bottom, coming up on another earnings report and say, gosh darn it, I have the worst timing in the world. I bought another stock. It went down. And let's face it, if I bought at 72 and it's now at 50, at least I have some money left. I mean, what if this earnings report is going to be bad? And then you let the stock go. You just lost, what, $20 a share? And the stock goes right back up? Because you're thinking, hey, $52 is better than nothing. Yeah, we don't have to do that with this strategy. With the married put strategy, just keeping it so simple. You were profitable by $12 a share net. You made $15 on the first put, and then you lost $3 on the second just for the insurance. You made on 500 shares $6,000. It's $12 a share. That's a lot of money. You have a lower cost basis now. And I'm going to say most importantly, maybe not even making the money, you were relaxed the whole time. You slept like a baby at night. You weren't freaking out. You weren't calling yourself names. Your risk was always predefined when that stock was going down because you had the long put there. Look what happened to the stock. Now it's up at 90. In 7 months of not day trading and swing trading, just holding your stock position because you knew it was good, it was fundamentally sound. You knew the market was likely to go higher. It is a bull market still. Look what happened. In 7 months, 50% return. And we only talked about one adjustment. So when we say the jug fills drop by drop, the keys are we don't panic in downtrends. Sure, it was literally the worst time trade. But we didn't care. We tracked it for our members and said, listen, this is how it can work. We like stocks with symmetry. And look how pretty it is. It's absolutely amazing. And you're not a deer in the headlights at any moment. Now, I said I wanted to keep it very, very simple so it affects the most people. To give you the framework of even if you have a stock that you want to hold long term, for whatever reason, we can really trade unemotional, hedged, and actually outperform many option traders, many stock traders. But in this example, we only looked at employing the long put option. As some of you traders know, it is possible to further reduce our risk by using call options. And I'm going to keep it really, really simple in this example too. If you remember back when we bought that long put option, we had a technical sell signal, a very basic one. We could also, keeping this slow and steady, simply add a short call, maybe go out 2, 3, 4 months, get about $3 in credit, because when technical sell signals occur, the stock is likely to continue lower, maybe sideways. If we add a short call, we collect that premium. That premium is ours to keep forever. We do have an obligation, though, to sell the stock at the short call strike price, but that's okay. We've gotten sell signals. The odds are it's not going to go up anytime soon, or hopefully not real soon. And even if it does, we can adjust that, but that's for another conversation. So the white circle up top is where we added the short call. As you know, the stock did trend down. But when we get into earnings, what we want to do now is buy to close that short call. Because while we could let it expire, if the company had an amazing earnings report, it is feasible the stock could gap up considerably. So you can let it expire, you can buy it back. If we buy it back, it's basically just going to be a nickel. And that's it. A nickel costs to buy it back at that stage, due to the stock's precipitous drop. And we also know the stock went back up to $75. Now here's the thing with short calls. If you understand options trading and you're proactive, you can add short calls on a weekly basis, a monthly basis, even go in the money and go after bigger credits, which is a more advanced application, something that we'll do. But a very simplistic approach, when stocks are in an uptrend, don't sell calls unless they're way out of the money. Which brings me to the rule of thumbs. Again, this is not advanced. I'm not making this the prettiest example we could. This is actually the low side, the conservative side. When a stock's in a downtrend, we want to sell calls against the stock. It's that easy. And when technical levels fail, we can add short calls there too. Prior to earnings, generally speaking, you do want to buy back those short calls so your upside remains unlimited. Just using that one little short call for a mere $3, our percent return on risk will increase, because by taking in that extra $3 per share credit, our cost basis is reduced. So instead of making $12 a share on those 500 shares, we're now making $15 a share. We're now at $7,500 profit on $500 shares, on 500 shares. So in that example, I showed you how to fix a broken trade, a broken stock trade, one that's in your long-term portfolio, even when it goes against your initial expectations. And what I want to do now is, this is the addition. I want to show you a very simple credit spread, which actually started out quite well. The stock began to break out, so we went with a bull put spread, and then it went against expectations. And some of you guys know we have an algorithm that selects stocks, and it works fantastic on credit spreads. So Boeing was the pick. And what I have on the screen right now is a chart of TradeStation. It's a daily chart, so each candle represents a single day. And it may not look like the most perfect chart, but the stock was breaking out. And the trade was signaled for entry on May 29th. Boeing did trigger bullish. So we went out to July, and we did a credit spread. Now, for those of you guys that don't understand credit spreads, it's okay. It's a very powerful way to trade, and if you ask many professional option traders, they love selling time. And if you ask them, are you a net seller or a net buyer of options? They're often going to crack a smile, wink, and they're going to know what you're asking. And they're going to say, yeah, probably a net seller. Now, I love buying options like the next person, and I enjoy it. I love short-term, longer-term buying of options. But credit trading, it's different. When you buy an option, you demand the stock move in a direction. If it doesn't go up or down, generally you're not making money. And every day you own it, that long call or long put, you're losing money. But with a credit spread, it allows us what I call wiggle room, price flexibility. If we place it below maybe a support level or at a support level, even if the stock were to turn lower, it might bounce from there and move higher. So with this credit spread, even though the stock is up in the 130, actually, let me see here. It's up around 134. We're going to initiate a credit spread whereby we're going to sell to open the 130 short put, which is that horizontal white line, and we're going to buy to open a 125. A $5 spread, we're going to try to make about 70 cents a share. Now, 70 cents divided by 4.3, which is the risk, it's about 16% we're shooting for in just over a month. After the entry, the trade is moving as expected, right? It's going up. Is it overbought? Well, the whole market's overbought at this stage. But yeah, it's moving higher. Okay. What happens next? What do you know? News comes out about Boeing. I believe it was specifically an order was canceled. Boeing drops. Huh. It's literally back to the place we initiated the trade. Now, this is the beauty about spread trading and often options trading in general. We can go from being a bull a couple days ago to being a bear in minutes, in hours, in days. Incredible flexibility. So after May 29th entering the trade, on June 11th, the stock breaks lower. It also gaps up on high volume. This is institutional selling. This is not you, me, and all our friends trying to sell. This is some serious moolah coming to the table. Now, what is vital in any trade is having your exit plans defined ahead of time. They have to be in place before the trade is ever initiated. This avoids being that proverbial deer in the headlight. We want to act instead of react, because if you don't have a plan in place to understand when something goes wrong, you're then in the moment, you're not thinking clearly, you're emotional, and you end up making mistakes. So here's what we're going to do. On June 11th, we know the stock gap's lower. That's the text in blue. The purple text says we're going to invoke the contingency exit plan due to a trend change. And what does that even mean? Well, the stock gap down on huge volume. It's now closing below 2 of the short-term moving averages. It gapped and finished at the lows. This is serious. We're not saying the stock's going to zero, but within the time frame of the options we're trading, the possibility of this stock rising we're going to pay 80 cents a share to close it. And that's the interesting part. The white circle was entry. We took in 70 cents. So imagine putting that 70 cents in your pocket. Fast forward 12, 13 days, whatever. The stock's back where it was, and now we're going to close it. But it's only going to cost us 80 cents. Interesting. Directional traders, they would have lost a lot more money. But if we had 70 cents in our pocket to start, and I tell you we're going to have to pay 80 cents to close it, what does that mean? That means you're out 10 cents a share. Now you could stop right there and say, you know what? I guess losing 10 cents a share is better than losing your shirt. I would agree. But man, I hate losing. I really, really do. There's times I lose, but gosh, I want to keep it as little as possible and as infrequent as I can. And what did I say earlier about being able to flip from being a bull to a bear so quickly? Well, that's what we're going to do here. We were a bull 10, 11 days ago. If I knew how every stock could trend forever, you'd be an oracle. That's not the case. We don't have that crystal ball. So when the stock does gap down, we are now going to initiate a bear call credit spread. And here's the beauty of options, especially on stocks that are heavily traded, like Boeing. We can even use weeklies. We originally had a July trade that was going to take about 5 weeks, 6 weeks to expire, and move into a weekly trade that's only going to take a few weeks to expire and still make money. By adding that bear call spread, we're going to take in 69 cents. Do the math. 70 cents in the pocket, 80 cents out, 69 back in. We've just adjusted according to our exit plan. And are we still making money? We are. Look at the bottom of the screen. We're still able to make 59 cents a share. Yes, we had some commissions, but if you're trading at a low-cost broker, for example, like a trade station, you're not getting killed on commissions. You shouldn't be paying $8.95 to do a couple contract trade. That's insanity. You should be down at a buck or even less a contract. So the cost to do this and the cost to initiate the adjustment should be so minuscule, it's almost not even a factor into your math. And what happened? Look at the yellow circle, upper right of your screen. Hey, the stock actually went lower the next day. And then it went sideways, essentially 5 dojis. It went nowhere for 5 days. But we're in a spread trade. We're in a credit spread trade. These make money when stocks go nowhere. That's the beauty of it. So on July 19th, we can actually get a 7.9% return by exiting the trade in 22 days. So we started out in July, we actually moved into June, shorter duration, and still made 7%. Yes, you had to pay 2 sets of commissions, I'm sorry, with a little bit of a laugh. But isn't 7% better than losing 10 cents a share? Better than not making any money? Just from going to be a bull to a bear? And you know what? If this stock then ripped up, we could close the bear and add the bull. What's really attractive about options especially credit spreads, is that you can go from being bullish, bearish so quickly. And when you're a net seller of time, you do not demand the stock go in a single direction. It can go in 4 out of 5 directions. We can still make money. It's a massive, it's so important that when you understand how to do credit spreads, it'll literally change the way you trade for the better and forever. So I'm going to keep moving here. I'm just watching my time. What I showed you today was a stock trade for long-term traders, how to fix it by using options. And I even showed you how we can do credit spreads, and we do this all the time. We even have a live trading room that we do this in too. We only use weekly options there. So this is something that we practice what we preach, and it's an amazing and powerful way to trade. It's one of our specialties. And what you need to understand is no matter how long you've traded, you're going to have mistakes. Sometimes they're your fault. Sometimes the market just moves. And understanding how to adjust, understanding how to minimize losses, how to turn losers into winners, whether they're bull put spreads, straddles or strangles, collars, ratio back spreads, diagonals, the stock replacement strategy, we can turn losers into winners. You don't have to master them all, but you know what? You want to start with one. Pick that strategy. If you're new to options trading, start with the credit spreads. Just get used to placing them. And if you already know credit spreads, let us show you how to adjust them. Because when you understand how to flip from being a bull to a bear and how to structure them properly, it makes a huge difference. So what I want to do today is, Mark and Kevin, when they invited me in, which was very kind of them to do, they said, hey, would you give our members an awesome deal? And frankly, maybe something better than you typically offer. So I did. I cut the trial in half. We often will offer this at $14 for 14 days. We made it $7. It is the best offer that we have. And what you're going to get is we're going to teach you how to hedge risk and increase your profit. We're going to talk about strategies that are working right now. And by the way, these are in live sessions, just like the title says. You're going to get access to 3 live coaching calls a week on Monday, Tuesday, and Wednesday. In there, we'll talk about what is an option, how to do income trades, how to fix trades. We'll talk about, if you have stock trades, how to sleep better at night, no matter what the market's doing. That also applies for credit trades, because you can actually be bullish and bearish at the same time, even in a market that's going up like this. And you might say, no, wait a minute. Think about this. Does the stock market go up every single day to a huge degree? The answer is no. The old phrase that stocks go up in an escalator and then down in an elevator, that's true. Stocks usually drop much faster than they rise. And even stocks that rise, they often stair step to a degree. And even if they do go a little vertical, they still pull back. You'd be surprised to know that we're actually placing bear calls, which are bearish strategies, but can profit in bullish markets because of time decay. The stocks just can't get there. We can also teach you guys how to do weekly income spreads, which is very, very important. We'll talk about precise entries and exits and a lot more. So I already mentioned that you will get access for this $7, which I want to point out is really, really great because you're getting 3 live coaching calls each week over your 14-day trial. That's huge. I mean, that comes out to basically what? $1.15 or $1.20 a coaching call. On Mondays, you're going to be with me. We're going to do the market outlook, talk about support resistance for the week ahead. I also take your individual stock questions. So if you want to know, hey, is my stock bullish or bearish? I'll help you with that. I'll show you why it is and why it isn't. On Tuesdays and Wednesdays, you get access to 2 of our coaches. I've personally taught these guys. They've also mastered this on their own as well through their own teachings, their own learnings. They'll teach you bull put bear calls, just like I showed you today. They'll talk about what strategies they're using. These classes actually allow you to ask questions via text live on the spot. They're all recorded and they're posted to the website. So if you're in Europe right now, it's pretty much the end of the day. It's margarita time. If you're on the West Coast, you might be just waking up. So depending where you are in the world and what time zone you're in, don't worry about the 9 o'clock time. They're recorded. You can watch them, and you can email us with any questions you have. You're also going to gain access to our on-demand videos, and this is a bonus, and I can't stress this enough. If you go to our website, you're going to pay $1,000 for this for the whole year. It's a big deal. There is no product we offer that gets more compliments, more testimonials. Every once in a while, we'll ask somebody, hey, can we use that for a testimonial? We actually have our members writing into us, even folks that are on trials saying, yeah, you know that testimonial thing? Yeah, these are the best things we've seen. So they're really amazing. What was important to myself and my partners when we built the company is there's lots of options education out there, and it's really good stuff. But often you end up finding that, gosh, does it really need to be that hard? I mean, I have no background in the stock market before 2000. I never went to college. In fact, I hated school. I was like, why can't I just learn about the stuff I want to learn about? I was a potato farmer, essentially. So I came from as far away as the market as you could get. And I started buying these books, and I'm thinking, you know, I'm not the sharpest tool in the shed, but gosh, I'm not dumb either. Why is all this jargon in here? So what was really important to us when we built these modules was to make it that if you're new to options, we're not going to over inundate you with all these fancy terms. Let's just make it simple and then gradually bring you up to the more advanced topics. So whether you're new, whether you're middle, somewhat intermediate, some knowledge, or you're advanced, when you go through our modules, and there's 40 videos in there, you're going to learn all these topics on the screen, and it makes, a serious difference in your trading. It puts it in a very simple way and teaches you even how to adjust trades. So really important. I'm going to speed up here. I also want to tell you real quick, and man, I'm watching my time. We just added this bonus for our members at Market Tamer, and we're going to share it with the folks here with Mark and Kevin, that we normally don't do trials into the algorithm, but we're going to give you trial access into our Market Timer algorithm. Every Monday, you're going to get one pick. This is a high expectancy algorithm. It is not probability based. Big. This is what some of the trades look like. I'm going to go really fast here. You're going to see companies that you're going to know well, like where people put spreads, percent 14 days. We're going to do directional trades. The bull put spreads, the bear call spreads, the frequency of winners is much higher. When you do direct 17 trades, you're going to have more losers, but the winners, they can win big. Philip Morris, here's Autodesk. Notice these trades are just a couple days. These are not long-term trades. Here's MasterCard from on Monday. It finished up on the day when the trade triggered in the white arrow, but the green arrow, boom, it crashed the next day. We got our profit 21%. So what's important is you're going to get 14 days. Let me back up a second. 14 days, you're going to get 4 live coaching calls a week, the algorithm coaching call plus the 3 educational, 40 on-demand videos. We're not only going to teach you options knowledge, get you up to speed, and you get to try us out for $7, but we're also going to give you picks. So we're going to take 50 traders. I know this is going to be going on all day, so if you want to jump in, it's the best deal we've ever offered. You can hop on right now by going to realtraderswebinar.com/Market Tamer. And when we hit 50, the page will go to sold out. So I want to make sure that you guys have any questions, I answer them. I am down to about 6 to 7 minutes. So I sped that up at the end. I'm not a hard sell person, so I just want to make sure that you guys know how good the offer really is. It is that good. It is that great. So here's what we're going to do. I'm trying to see questions here. Let me pop this out and open it up down here. All right, received. Here we go. Now I can finally see the times. All right, here we go. So if you have questions, please do ask. And I will answer. All right, let's see here. Where can I find option fees that low? I'll tell you what, Henry. I have a great relationship with TradeStation, and if you're looking for a paper trading platform, I can get you set up there if you want. That's up to you. My email is cs@markettamer.com. If you guys have any questions, drop me an email. But I don't care where you trade. You can trade wherever you want. Um, there's a comment that if you're a beginner, stay out of biotechs. I couldn't agree. I couldn't agree more. Biotech is crazy. Um, really, $7 includes a year of the video on demand. My point in the video on demand is we charge $1,000 a year for that alone. As part of your trial, you're going to get access to it. So for $7, you're going to get 14 days access to everything on the screen. It's an amazing deal. You can try out so many aspects of you're getting the full coaching program. You're getting the market timer algorithm, the video on demand lessons. That's what makes it such a great deal for those 14 days. Let me see. What happens after 7 days? It rebills at $3.98 a quarter. Do you have to use TradeStation to use our algorithm? Oh gosh, no. Hey, listen, if you guys are at Options Express or Interactive Brokers or Trade Monster, Scottrade, Fidelity, oh, you can stay there. The algorithm is proprietary to us. We actually have programmers on 2 different continents. And because one of my business partners is a hardcore engineer programmer, they don't even know each other. So we've protected the code really, really closely. So we don't allow like a Thinkorswim or a TradeStation to get access to the code. We keep the code. The stocks are posted on our website. So you can use whatever brokerage account you want. It's that easy. What is the cost of your education after the 14-day trial period? It rebills quarterly, so you're not locked into a year. It's just $3.98 a quarter. It's that simple. And the webinar, the special link that we have, because we actually took our own special link down, because when we tell our folks it's only up for a limited time, it truly only is. So if you guys go to realtraderswebinar.com, which is the sponsor today, /Market Tamer, our name, you will get access to the deal. It's because our own page is not even up. All right, I see I got about 4 or 5 minutes yet, so we're doing good. Bob, can you use eSignal? You sure can. Is it possible to repeat the offer? How we get it? I think, hey, Francesca, I think I just did. So if please ask your questions again and I'll answer. Neil, do you prefer weekly bull puts over monthlies? It depends, Neil. I love credit trades. Given the choice, I want to be doing credit trades much more than directional. Hey, if I see Tesla breaking out, I see Apple running, gold crashing, whatever it is, I do go directional. But the sweet spot are these credit trades. There's so much flexibility, and the ability to adjust is often there every time, or almost every time. But specifically to your question, do I prefer weeklies or monthlies? I prefer weeklies. I'm sorry, monthlies myself, and here's why. I love running a business, so I'm very active in the business. So I prefer monthlies or every couple weeks. If I'm going to be available to trade for a week or two that I know I'm going to be at my desk type of thing, then I do weeklies. They're 2 different animals. If you're going to do weekly options, you literally need to be available to trade all day, because we do actually have a live trading room, which is a separate product. And when we send out an alert, you have to act instantly. You can't wait 3 hours. Whereas if we're doing monthly spreads, it allows us a lot more flexibility. You can actually be at work all day and still do credit spreads. Generally, you can get out of them. If there's a massive gap, well, you're just SOL no matter what you do. There's nothing you can do then. So it depends on your own time allowances. And weeklies is basically trading options after drinking like 10 Red Bulls or 5-hour energies. It really is fast action stuff. I love it, but you got to have the time. So if you told me, for example, you're a doctor, you drive truck, maybe you're a landscaper and you're out all day, don't do weeklies. You got to be able to have alerts sent to your phone to do weeklies. All right, let's see here. Oop, I got a message. Okay, there it is. Perfect. All right, next question. Adam, Priceline, I don't trade Priceline personally. One of my coaches does, but I can't bring up a chart right now because of the application we're in. How much do you need an account to do credit spreads? Okay, I can't tell you a specific amount because the government won't allow me. My humble opinion, minimum $5,000, with 10,000 being ideal. If you told me you had like 2,500 bucks, my humble personal opinion, I'd rather you save your money, get a bigger amount, and then start to trade later. Martin, I don't trade currencies. I trade stock options and I do some futures. Dylan, how much is our weekly course? Dylan, if you want to email me, we can get you a deal on that too through Kevin and Mark today. It's a separate offer. But our email address is cs@markettamer.com. So let me just put my email down here one more time. I'm going to have to wrap up here in about 30 seconds. Are these methods applicable in Forex trading? Amir, I would say no, but I don't trade Forex either. But I'm going to say with 99% certainty, the answer is no. Now, can you go from being bullish to bearish using moving averages? Yes, but not the way we showed today, no. Does your card get charged, or when does your card get charged for Pete? This is how easy it is. You try the trial today for $7. You have 14 days. Just cancel by 14 days. That's all you got to do. On day 15, we're charging your card because we told you we would. So if you don't write in, we're going to charge you. You cancel by day 14, I promise we won't charge your card. We're very upfront. John, is this separate from our live trading room? It is. This is a way for you to not only learn to trade options, but also get trades given to you to follow along. You're interested in the weekly course, drop me an email, cs@markettamer.com. Okay, I want to respect the time today because I know that Mark and Kevin have an absolute boatload of awesome presenters. I see Peter's here. I see Chris is here. You guys are going to be in some awesome hands today. So today's a great day to learn, pick up a lot of strategies from some awesome presenters. So I want to say thanks to Kevin, thanks to Mark, having me in here. I always love coming because you guys are so polite. You have great questions. And the fact that you ask questions makes my life easier. So I enjoy this. Thanks again. I wish you guys a great weekend, a happy summer, and hopefully I'll see you guys again in the future. So take good care. Thanks again, Kevin.
Thank you, Ron. Guys, just again, I just want to give you the link to check out Ron's offer. I mean, that offer is not something that you'll see again, and it's such great value. Again, the link is going to be realtraderswebinar.com/markettamer.